Hello, everyone. I'm thrilled to announce the start of today's webinar from the practical perspective. So we'll cover some theoretical aspects of MiCA regulation and the travel rule. And also we'll be covering professional experience of Chris, who's also joining today from Bitpanda's experience in obtaining those MiCA licenses. As you may know, Bitpanda is one of the first to obtain 3 MiCA licenses in different European countries. These are Germany, Malta, and Austria. My name is Andrei Sribny. I'm the CEO of AML Certification Centre, which is an internationally accredited certification and training provider in the anti-financial crime field. Recently, we have also launched a certification program for MiCA CASPs, MLROs, and compliance officers. And today we're accompanied by Faisal Islam, the CEO of Complytek, which is a RegTech provider offering a centralized AI-powered customer lifecycle management platform that covers all KYC and AML needs, like onboarding, risk assessment, transaction monitoring, case management, and reporting. He will be sharing the perspective regarding the MiCA regulation from the technology solution provider perspective. Also, as you may have seen in the announcement, today we'll be drawing a prize to one happy active. Let me point out that Adam D, who's participating today, he'll receive access to the Certified Anti-Money Laundering Senior Specialist Certification Program. So stay tuned, be active, ask your questions. Probably you will get the access to that credential. All right, today's agenda will start from my part regarding the MiCA context, the new updates. As you may have known, for example, Lithuania prolonged their grandfathering period till the end of the year, and the travel rule, the context, the current challenges crypto asset service providers face in those fields. Then Chris will give his presentation and professional experience of Bitpandas in obtaining MiCA licenses, and then we'll switch to the presentation of Faisal regarding the main challenges for CASPs applying for a MiCA license. And then we'll close with the Q&A session / panel discussion. Also, really important to point out that every attendee will receive a certificate of participation to their email, so stay tuned. All right, let's start from MiCA in a nutshell, why it matters. So it was created essentially with the European Union's response to the rapid growth and the volatility in the crypto market. And over the past few years, we have seen crypto booms and busts and big price swings, sudden collapses of major players. And so the European authorities wanted to address this issue with this unified approach with MiCA regulation. And another major driver was the lack of harmonization across EU countries. Some countries have had previously some licensing approaches, some not, and there was a need for a unified approach to it. And finally, there is the issue of anonymity and the potential systemic risk that comes with it. Some crypto activities have allowed users to stay under the radar of authorities, and that was a big concern for both financial stability and financial crime prevention. It applies to crypto asset service providers or virtual asset service providers formerly, and to anyone issuing crypto assets or stable coins within the European Union and the access and who want to access the European market. And it focuses on 3 key areas: customer protection, market integrity, and the last but not the least is financial stability. So in short, MiCA is the European Union's big step forward in making the crypto space safer, more transparent, and more predictable for users, businesses, and regulators alike. And the timeline, how it rolled out, it started in June 2024. This is when the rules around stablecoins kicked in. So that includes asset reference tokens and EMTs or e-money tokens. Then we moved to December 2024 when MiCA came live, which was the big milestone for crypto asset service providers. So whether you're running a crypto exchange, wallet service, or another crypto-related business, you'll need to meet MiCA standards from this point on. if you are starting out or entering the European market. Also, a grandfathering period for already operating crypto asset service providers, which will last until July 2026, but it depends on the country. For example, one of the major updates that we've seen already, that Lithuania prolonged their grandfathering period until the end of the year. So let's quickly talk about the current challenges that crypto asset service providers face with MiCA regulation and all the regulations that we have in the European Union. And one of the most widespread immediate challenges under MiCA is around how crypto assets are classified, and particularly when it comes to stable coins. MiCA splits them into two main categories: EMTs, or e-money tokens, and ARTs, or asset reference tokens. And understanding the difference is essential to comply with the regulations. So let's start with the EMTs. These are stable coins. They're denominated in a fiat currency like euro or the United States dollar, and they behave similarly to traditional e-money. And in many ways, they are treated like it under the PSD2 directive. So there is also a complexity, a challenge currently that we don't have any formal answers now from nor from the European Banking Authority nor from the other regulators regarding the intersection between MiCA regulation and PSD2 directive. So it will be a very important issue to monitor closely. Then we have ARTs, or asset reference tokens. These are stablecoins. Those value is backed by assets other than fiat, like gold or a basket of different currencies. ARTs are treated differently under MiCA because their structure carries different risks. For example, greater volatility depending on the assets backing them. And now here is the real challenge. Some tokens blur the line. In practice, it's not always obvious whether a token is ART or an EMT, or potentially both. For example, a token might be linked to a currency, but also to a commodity, which puts it in the gray zone. And this creates compliance uncertainty. And for example, let's take a look at Tether. Tether claims to be backed 1-to-1 by the United States dollar. So at first glance, it might seem like a clear EMT. It's a fiat denominated, and users are supposed to have redemption rights, which are applied to EMTs. But when you dig deeper, you find that its reserve composition includes also things like commercial paper, corporate bonds, and etc. And these aren't fiat. They are non-cash assets that starts to resemble an ART because the value is tied to a broader range of assets, not just one currency. So how do we classify it? This is where MiCA guidance questions help. If it's backed purely by fiat and users can redeem it in fiat, it's likely an EMT. But if it includes commodities or other assets, it leans towards being an ART. Here you can also see a checklist on the slide how to classify assets correctly. So if it's one-on-one backed by a single fiat currency with redemption rights, it's an EMT. If it has any other assets, if it not only has like currency or fiat and consists of other assets, it's an ART. And if the user have the redemption rights in fiat, it's an EMT. And other challenges, the main challenge here, I talked to crypto lawyers and they raised this one as the most widespread challenge, is that the applicants, MiCA applicants, don't adequately calculate the resources needed to be compliant with the MiCA regulation. The manpower, the number of compliance professionals needed in a compliance department to be compliant with MiCA, not only have those policies in place, but actually to create those policies and maintain that those policies are operational. And this is a huge compliance burden. Faisal will cover it more in detail during his presentation regarding the different periods, what periods of time CASPs need to receive the MiCA license. So also different national approaches to MiCA's transitional period, and not only to the transitional period, but also to the application itself, and varying supervisory and enforcement readiness across the European Union. The travel rule. A little bit of context. What is travel rule? The travel rule stems from the FATF recommendation number 16, and its goal is simple: to bring crypto transfers in line with what's already expected in traditional finance. Under the rule, virtual and crypto asset service providers must collect and share sender and receiver data when processing transactions, just like banks do with wire transfers, for example. And this requirement kicks in for all transfers and for self-hosted wallets. In Europe, it comes from the transfer of funds regulation, and it applies to all transactions, but to transactions initiated to self-hosted wallets, it's only for the transactions over 1,000 euros. And they require the verification whether the funds are being owned by the person, which creates an additional challenge, of course, how to verify it. The cornerstone of travel rule compliance is, of course, customer due diligence and ongoing due diligence, especially as transactions move between platforms. So while MiCA sets the structural roles for the market, the travel rule ensures the traceability and transparency of the money moving through. Here is how it works in practice. When a user initiates a crypto transaction through a VASP or CASP, that VASP must collect, verify, and securely transmit certain information about both the sender and the recipient. This includes names, accounting identifiers, and other relevant details according to the regulations. The receiving VASP must then screen that information, carry out its own due diligence, and decide whether to accept or reject the transaction, especially if there are any red flags like sanctions, hits, or missing data. And importantly, this rule applies even if the transaction involves a self-hosted wallet, like hard wallet, as long as it's 1,000 euros or more in the European Union, in which case extra verification steps are required, like the signing challenge. And the complexities that we see with the travel rule implementation among crypto asset service providers are non-compliant VASPs. The travel rule requires that information is only exchanged with other VASPs who are also compliant. But in practice, many crypto companies still don't meet the standards, especially those based outside the European Union. That's why we're seeing more and more talk about VASPs maintaining whitelists. In other words, only interacting with verified, trusted counterparties. But managing and updating these lists takes time, coordination, and for sure, legal clarity and constant updates. Then there is a big question of data protection also. The travel rule pushes firms to collect and share personal information, but GDPR hasn't gone away. So CASPs need to find a careful balance between AML obligations and privacy rights. That means applying principles like data minimization, ensuring the data shared is only what's strictly necessary, and protecting it appropriately. And it gets even trickier when we bring self-hosted wallets into the discussion. These aren't operated by VASPs at all. So how do you verify the owner? One solution that's emerging is using a signing challenge, for example, where the user provides their control. They control the wallet by signing a cryptographic message. This still requires technical infrastructure and consistent standards, as some of the self-hosted wallets may not have this functionality. Ultimately, the travel rule, it doesn't override GDPR compliance, so crypto asset service providers can't ignore privacy rules in the name of AML. Regulators expect that CASPs comply with both. That means walking on a fine line, gathering enough information to meet those obligations, while still respecting users' rights under data protection rule. And some recent updates, these are not yet live, but as you may know, in February 2025, the FATF released a new consultation, which isn't live yet, but it gives just an idea of where things are heading with the travel rule. One notable clarification is about who is responsible at the start of the payment chain. The FATF now refers to the CASP or financial institution that first receives the instruction to initiate a transfer, not necessarily the sender's provider as the one responsible for collecting and transmitting the required data. So this update comes from the clarity regarding who is responsible for this travel rule compliance, and they just made this terminology clearer. And another update involves the transfer of personal data. Under the proposed revision, CASPs would only need to send the date of birth of the originator rather than for both parties. So previously we didn't have these requirements regarding date of birth, but to reinforce the transparency and also customer due diligence procedures, they want to include the date of birth also to the list of the important information being shared in the travel rule. This is aimed at reducing unnecessary data, that the date of birth is provided only for the originator. It is aimed at reducing unnecessary data under the GDPR. So these updates, while subtle, will have an impact on how CASPs handle responsibility and data sharing. So it will also be important to keep on those updates and what's coming. And let's wrap up this MiCA presentation with a few best practices for CASPs. Preparing for MiCA, already having MiCA, first and foremost, it's compliance talent and training. This is critical as we have many updates. We have those consultations, different European Banking Authority workshops and etc., and clarities on how to navigate the MiCA. There will be even more different guidelines, and it's as important to always train on those guidelines. You're not only in compliance, because you need people who understand both the regulatory detail and how to translate that into operational process. That's why the training is necessary. The second one is adequate resource calculation, as I've already mentioned. Some of the applicants don't still clearly understand the whole picture on how much resources are needed to maintain and even to apply for a MiCA license. And also technology solutions to verify whether it's a self-hosted wallet and to maintain those white lists. It's more adequate to have some technology in place. And also the third-party due diligence, as some of the technology solution providers may be based outside of the European Union. You should perform your third-party due diligence to make sure that the technology solution providers are compliant with all the new regulations and they are staying updated and update their technology. This is it with my part for now. And now I would like to give a word to Chris with his presentation and his personal experience with Bitpanda's MiCA license. Please, Chris.
Thank you very much, Andrei, and thank you everyone for joining this interesting session today. I hope that it will be to the benefit of everyone, and I hope that in the minutes to come, I'll be able to walk you through some of the highlights of my experience at Bitpanda heading the compliance function in Malta, which for those perhaps not familiar with Malta, it is a small island in the Mediterranean, which for the last 30 years has been setting itself up as an international financial center. More in particular to the topic today, since 2018, it has been actively trying to set up a framework for operators within the crypto space to be able to offer their services to customers in a safe way. I am a lawyer by profession, and I've been practicing now for the last 10 years within the financial services realm. In particular, I've been following the developments in MiCA since the very beginning. And today, I'm happy to say that with MiCA coming into force, we are seeing now more serious operators taking into consideration the safety and the security of their investors and customers, whilst also obviously maintaining their competitive edge. I'll be sharing today a presentation which basically is there to serve as a bit of a high-level indication in terms of the topics that I will be discussing. You will notice black and white pattern, even what I'm wearing. I promise it's purely coincidental. I am a Juventus fan, for those who are football fans, but again, purely coincidental. and especially with the season that we've been having, perhaps time to stop about mentioning that, especially with our first rivals now in the Champions League final. Hopefully, PSG, being one of our crypto partners as well as Bitpanda, will be able to get me some revenge in the weeks to come in the final. Joking aside, the idea today, as Andrei has already explained, is to basically walk you through some of the things that I've noticed in my experience as a compliance officer as well as a consultant in the past in terms of how applicants should approach the MiCA process. Of course, we will be going through the need for early preparation and why it is very crucial to be proactive in making sure that in preparing the application, one takes into consideration a lot of the different requirements which are in place. We will also go through the reasons why entities typically choose to seek MiCA authorization, as well as the importance of collaborating with regulators, be it if you are operating from one country or if you're operating from more than one EU jurisdiction like Bitpanda. But of course, it is still a relevant topic for everyone because ultimately, if the aim is to target consumers across all of the EU, there are still some obligations which one would still have to keep in mind. I will also be going through how we as Bitpanda decided to structure our processes and how we manage these internally. And then ultimately, I will close off this section, this segment of the presentation on how we managed to achieve this internal readiness going into 2025. So, of course, early preparation for me is key. And I think under MiCA, it is one of those things where, quite frankly, it's not even optional. From my experience, if you're heading into an application process without having first assessed and analyzed the capabilities of your organization, more often than not, you're immediately going to find stumbling blocks. This is due to many things. We have seen a lot of developments which have taken place, of course, on an EU level, but despite all of that, there are still local nuances which one would have to factor in to make sure that, again, the moment that a company is licensed, it gets off the right foot. It is important for organizations to keep track of all of the RTSs and guidance that has been published by ESMA and other notable authorities, and to make sure that ultimately, wherever you are operating, be it in Malta, Austria, Germany, or any other EU member state, that you are in line and monitoring with any domestic regulatory requirements. Different authorities, of course, have different expectations, but the positive aspects of MiCA, as opposed to perhaps other types of legislation, such as MiFID, is that we are dealing with a regulation. So here we are speaking of a piece of legislative framework that intends on harmonizing requirements across all EU member states. So unlike a directive, we are not here speaking about merely minimum standards, which is then up to a member state to implement, but rather we are speaking about a far-reaching regulation where member states have no choice in terms of applying certain requirements. And I think that is where the whole topic of strategic readiness starts coming in. Being able to proactively identify requirements envisaged under MiCA allows one to align the business model with those requirements in advance. Something which, from my experience, I have noticed, especially with perhaps companies that are still starting out, is that it is the other way around. We first have a business model, we go with the business model to the authority, and then later on we start finding out of requirements that need to be in place, which ultimately results in us having to change that business model. So, in order to avoid surprises and delays in the authorization process, it is very important for applicants to make sure that they understand their strategic model and how that fits within the whole MiCA frame. Of course, this touches as well with resource planning. And of course, two of the main items under MiCA that impose certain level of commitment on applicants is that relating to capital and people. Nowadays, applicants, as opposed to the past where perhaps they would have been operating under a light touch regulatory framework or no regulatory framework at all, MiCA mandates that companies would need to have at least certain minimum standards in place to ensure that they can sustain any challenges that might crop up during the business of the company, especially after it commences. Financial resources has to be proportionate to the scale and complexity of the business involved. So if we're speaking about a cryptocurrency exchange that has millions, if not billions, of volume and trades going through its infrastructure, it is not the same when compared to perhaps a smaller CASP that is facilitating much lower volumes. So the regulators are going to take a case-by-case approach where they try to understand the risks of a particular applicant, and in accordance with their risk, they will then impose requirements to make sure that such risk is mitigated. Nowadays, regulators, from my experience, take staffing very, very seriously. So gone are the days where basically people come and go. There is no contingency plans in the event of key function holders leaving. And with MiCA now coming into place, we are seeing regulators pressing more on applicants providing information on how they intend to carry out their business and how they intend to design their organizational structure. So, of course, the need for these key function holders is there to demonstrate operational readiness. It is there to demonstrate that upon a company receiving its license and being given the go-ahead to operate, that there would be the people in place to actually run the business in a legitimate and secure way. What is important is balancing commitment and flexibility. And this is where the usual chicken and egg situation would come in, especially for those applicants which are perhaps at a more startup phase. When do you start employing the key function holders, be it the money laundering reporting officer, be it the compliance officer, some of the directors, the risk manager? My advice will always be not to overcommit, but at the same time, there is the need to show credible intent to the regulator. So whilst readiness isn't all about going all in from day one, going to the regulator and showing them a clear plan as to how you intend to actually run the business from an organizational setup point of view is very important. It's not just important in terms of identifying the roles, but also in identifying the people and making sure persons, the professionals that the applicant is putting forward are of high regard, they are fit, and they are proper. And of course, this takes time. Every person would need to undergo this process with the respective NCA in the jurisdiction where the application is being submitted. Different regulators then have different approaches in terms of how this is done. And obviously that brings us to the next topic, which is collaboration with regulators, which I think is very crucial in having a successful application process. As we mentioned, being proactive and having early communication with regulators, I feel is significantly important. I feel transparency builds the necessary trust that is needed for the regulator to know that they are dealing with a serious player. Because let's face it, despite the lot of promising elements that the crypto industry presents, there are also some bad apples. And if the regulators would not have the transparency needed, it is just going to make it more difficult to vet and approve. Being transparent about your business model, being transparent about your organizational structure are all elements which, from my experience, regardless of where the regulator is situated, it's always going to be at the top of their agenda. If you are dealing with multiple regulators, Bitpanda, as Andrei mentioned, was one of the first companies in Europe to get a license in more than one jurisdiction. Having different regulators and dealing with different regulators does present its own challenges. Prior to MiCA, different jurisdiction approached regulating the industry in different ways. So we've had member states who were, I don't want to have anything to do with it. I let companies carry out their business operations as they wish, as long as they adhere to the AML obligations, which of course are mandated under the AML directive. However, we've then had more proactive member states such as Malta or Germany who didn't wait for MiCA to come around, so they had already a homegrown regime in place to attract service providers within this realm. In dealing with these different regulators, you have to change your approach. because the regulators, like organizations such as ourselves, they have their own limits and they have to go through their own learning curves. All of these legacy systems will ultimately influence the regulator's own resources, expectations, and approach. And I think it is key that one understands the dynamic in which the regulator would be operating in, because it will have an effect on the application process. Internal readiness, of course, is another big topic, making sure that what is written down on paper, black on white, is actually implemented in practice. So everyone can come up with very nice business plans, very nice descriptive ways of how the company intends to run its business. But then once it commences, it's a whole other matter. And we have to make sure as an organization that we actually implement and put into effect anything that we would have guaranteed as part of our application. So it's very important that internally an organization prepares itself and makes sure that its staff and its infrastructure are in line with what is being proposed within the business plan. Executive buy-in is critical, so of course the compliance officer alone cannot be expected to ensure that a company or an organization is MiCA compliant. There needs to be the buy-in from the people at the top. Be it if it's a founder, if it's a C-level executive, they need to also be aware of what MiCA entails, because ultimately it is very crucial not only to get a license, but to maintain it. And in order to achieve those two things, you need the executive buy-in. Last but not least, as Andrei mentioned, a very important aspect is making MiCA understandable. Not everyone in an organization is a lawyer or is a compliance officer or an MLRO, but it does not mean that they have the benefit of being ignorant to the law. And it is down to each organization to make sure that the staff, depending on the level and depending on the role, are aware of the obligations that come out of MiCA that affects them. And again, this is a requirement which is expected on each and every license holder in making sure that companies are aware. Some of the best practices, and I'll try to go through it conscious of time. I will not deep dive in any topics, but the question is when to start. The short answer is not when you click submit. Many founders, C-level executives believe that getting a license is purely admin exercise where you get to fill an application form, submitted, the regulator has a checklist with just crosses off things, when the reality is a completely different aspect. My advice here is, as we've mentioned before, is to have a clarity on the business model that the C-level or the founders want to achieve, and to then make sure that all regulatory efforts would be aligned to this business model. As we've already mentioned, I think aligning with the regulator's language and expectation is also an important aspect of having a successful application process. Each NCA has its own way of working. Sometimes there are also language barriers where, certain countries might opt to have their processes in their native language. Depending on the situation, one has to make sure that as an organization, they are ready to handle that particular process. And of course, responsiveness matters. So regulators do expect clarity. They don't expect each time that they ask a question for them to have to wait months on end to receive a reply. So in being prepared, you are going to be in a better position in getting back to the regulator and giving them the information that they seek. I think by having the right infrastructure and awareness in place, not necessarily having all the policies or documents ready from day one, but of course, it is an important aspect. And I think in getting a swift application being approved, a lot depends on having the right policies and procedures in place. Obviously, there are some which carry more priority than others. So if we're speaking about AML, risk management, governance, these are all areas that the regulators are going to focus on. This is not to say that other areas aren't just as important, but again, depending on your resources, you should be able to prioritize those areas which you know are going to invite more scrutiny from the regulator. Last but not least, some of the challenges and lessons learned. So again, what slows down the process and how can it be resolved? Typically, many of the delays would stem from misinterpretation or misalignment, sometimes changes which are brought about by the regulator, which are obviously catch the industry by surprise. But of course, through assigning clear internal owners for each areas and establishing the business model in advance. I think these would be key in having a solid approach and making sure that an organization is ready to pass the benchmark being set by MiCA. A hot topic is always that of balancing innovation and compliance. So I always speak about commercial compliance, where it is pointless trying to be 100% perfect if that means that you are no longer competitive. So the task at hand for a proper compliance officer is making sure that the company, of course, never breaches any regulation, but then is intelligent enough to see how best to leverage that. The lessons learned is obviously then innovation and compliance don't need to conflict, but of course, alignment must be planned, must be deliberate. We've already touched about this topic, so I won't delve into too much again, conscious of time. Jurisdictional variances exist even within the EU despite having a common MiCA framework. Legacy regimes, supervisory style, regulatory resources, all of these shape how MiCA is interpreted and how it is enforced. Having a regulator like the Maltese MFSA, for example, which is used and has experience supervising CASPs, is different to a regulator such as Portugal, for example, which to date has yet to define exactly how the regime will work in that particular jurisdiction. So investing early and understanding the local regulatory context is important. Don't treat MiCA as monolithic. Tailor your strategy to each jurisdiction's enforcement culture. What's next for Bitpanda? Obviously, it's to scale up our growth, adapt to ongoing MiCA developments, meaning keeping our finger on the pulse and building trust through compliance. To sum it up, the three key takeaways which I will bring with me today is to start early and think strategically. As I mentioned, MiCA licenses isn't about ticking boxes. It requires early planning, deep alignment, and clarity on the business model being put forward by the applicant from day one. Compliance, in my opinion, and this is the second takeaway, is a competitive advantage. So for me, any founder or C-level which argues the contrary is going to find a brick wall in trying to convince me that compliance is a purely burden. And last but not least, and I think quite an important third takeaway, is to stay agile. The crypto industry is very dynamic, things change very fast. So if you're unable to keep, again, a finger on the pulse of the industry, you're going to find yourself expired or out of date in a very quick time. I hope that you've enjoyed the presentation, and of course, I'm looking forward to the Q&A session to answer any questions that you guys might have.
All right. I guess I'll continue. I'll try to wrap it up as quickly as I can. I know there's a lot of questions coming up, so I'm just going to go ahead and quickly show my screen. Hi guys, my name is Faisal. I'm the CEO of Complytek. A little background about myself. My first interaction with cryptocurrency was as a compliance officer in 2012. Some of you were very, very, very young. But 2012 was the first year I was a compliance officer for cryptocurrency exchange in San Francisco called Buttercoin. I think I knew one other compliance officer who was also compliance officer for crypto exchange. I can tell you that the landscape and the requirements have drastically changed over time, and I'm super excited to see in my old age all these young guys like Andrei and Chris and everyone else that's participating in today's webinar get excited about crypto-related AML regulations and just regulations, period. So things have definitely changed. Obviously, a lot of things haven't changed, but I'm really excited to see the whole change and the transformation over the last sort of decade and a half. If you ever want to ask about the old days, I'm happy to talk more about it. Okay, so that was my earliest interaction with cryptocurrency as a compliance officer. Over the years, I've worked also in compliance on different other aspects and projects and so on. A lot less now, but still very much involved through our firm Complytek. So Complytek is a regulatory technology company. We do end-to-end onboarding, risk assessment, transaction monitoring, transaction screening, and case management for 4 categories of customers: banking, EMI, VASPs, and FX. So these four customer categories are who we serve to provide a single unified platform to be able to carry out all your anti-money laundering requirements. We also have integrations with your on-chain monitoring provider if you do have one. So bring your own on-chain monitoring provider and we integrate directly with our platform so you can review all of your AML risks, both on-chain and fiat holistically inside of a single platform. We've seen a certain amount of increase in demand of our services because post MiCA, you're required to have just as robust of a fiat monitoring and screening program as you used to have on your crypto side as well. And we have several VASP customers that can testify to that aspect. We're more than happy to chat more about it. So with that, welcome. The part I'm going to be talking about is slightly different because I imagine some of you might be actually in attendance. So we work with all different types of participants, VASPs included, that request our technological services for AML implementation. And off the MiCA category of customers, we have 3 buckets of customers that we've received so far. So here are the 3 types. First, MiCA applicant is generally a brand new CASP, no transactions, no customers, white paper in hand, a domain and so on, and is sort of applying for MiCA. So that's a brand new CASP. The second level of customers that ask for our services also is an existing VASP that existed prior to MiCA and needs updates and upgrades to their tools as part of their MiCA application or approval. Okay, so we've had existing VASPs receive our services, whether they're applying in South Africa or Italy or Lithuania and so on. And then there's a third category of customers. These are customers that are not VASPs prior. In fact, some of them were FX trading, some of them were in the banking sector, and they add products and features into their general deliverables that have crypto components. And for that reason, they need to get a MiCA license. And so they also come to us to provide them additional support. So they're existing customers of ours, but we have expertise in integrating crypto-related solutions, so we help them also. So these are 3 different customer categories that we have experience with. Now, as I go through this, you're going to realize, even though MiCA's regulations are fairly uniform for all participants, each of these 3 participants have very different needs and also internally have to do very different things from each other, even though they're applying for the same license. So this is sort of behind the scenes of what happens on these 3 different applicants. And some of you might identify with one of these participant categories. So feel free to ask us any questions on that end. I'm not going to go through the licensing path. The licensing path itself, Andrei and his team can help you guys with this. And Chris can provide also some experience on the second part, existing VASP, because Bitpanda was also a VASP prior to MiCA. So, I'll leave it to you guys and lawyers to be able to tell you more about the licensing path itself. But putting bullet points, brand new CASP obviously has to have a white paper and prospectus and a full CASP application. If you're an existing VASP, then you need to do a gap analysis versus what you have now versus what MiCA requires of you. Make sure you put those in place. Relief notifications of transitions and obviously any updates to existing licenses that you have that are non-MiCA. And non-VASPs that require crypto products, so they need to amend their existing either investment advisor license or EMI license that they have, and they might ask for a limited CASP authorization. So these are some bullet points for each of these different types of applicants. Now, compliance obligations, that's where we've noticed they do things a little bit differently. So obviously, if you are a brand new VASP, you need a full anti-money laundering customer transaction framework, right? Because you've never done this before. And so you've got a brand new framework, brand new policies, procedures, and brand new IT governance structure. You've never had experience with it, but you sort of have to almost draft new documents as a result and then put them into place. If you're an existing VASP, this is to some extent, depending on which spectrum of compliance you're in, you might have already had a few of these things. So you'll need to update some of those AML KYC thresholds in order to match MiCA's expectations. There's also a lot more standardization with regards to reporting and policy rewrites that you'd have to have in place. Specifically for MiCA, these are under Articles 55 to 58. And if you are a non-VASP that's now adding crypto products, in order to be able to compliant under MiCA, you'd have to integrate some of the modules that have to do with custody and trading. And you'd also have to extend your AML KYC program to include the crypto specifics as well. So here's sort of in a nutshell in bullet points, the obligations that are different across these three MiCA applicants. Some other areas as well where they have differences on the operational tech setup as well as capital and governance. So if you're a brand new CASP, generally you build some type of cloud native architecture. You might have in-house governance and risk tools. But if you're an existing VASP, you might have some legacy stacks that would need to be sort of retooled for MiCA APIs and audit trails. And you'll certainly have to upgrade a lot of these secure custody agreements that you have in place. If you're a non-VASP that's now adding crypto products, there are certain white label platforms you can use. And again, we're not advertising. This is just sort of common market requirements. There are not much in-house developments that you might generally need. On the capital and governance structure, of course, there are new initial capital requirements if you're brand new CASPs. This depend on countries. Some countries it's as low as 100, some countries as high as 700. So it depends on the countries that you're applying in. If you're an existing VASP, chances are you might have an existing license somewhere or whatnot. So you might have to top up your capital requirements. So if you were in a certain country where operating required your capital threshold of X, and for MiCA license, the threshold might be higher, just need to top up for that. And you need to revise your governance chartering committees to make it more applicable. And finally, if you're an existing licensed provider of other types of licenses, and you're now back in, you're adding MiCA, you might have to demonstrate what's called fit and proper for the crypto add-ons. And any type of capital allocations you need to add will be pro rata based on the number of services or the volume of services in crypto that you do provide. You don't have to include actually initial capital because most other licensing structures, whether that's banking or EMI licenses, have a licensing structure and capital that's far exceeds MiCA's requirements. So that you don't have to increase. But if you do have obligations that have to do with crypto products, you need to add the outstanding obligations if they do exceed whatever allocations you've already had. Here is the interesting thing that we see that happens quite a bit across these three participants. There is an offboarding issue that has to happen. So if you're a brand new customer, you don't have to worry about this. You don't have customers, so you don't have to offboard anyone. But if you're an existing VASP, and we've seen this, every single one of them have a sort of moment where when they realize the threshold of risk tolerance that they can have internally, contrasted with MiCA's expectations are, there's a certain category of customers that would not be applicable to keep on your customer database should you want MiCA approval. And for those of you that are in our existing VASP that are going through this application, know exactly what I'm talking about. You had different onboarding risk appetites, and you had different operational risk appetites prior to MiCA. And due to MiCA, you'll have to offboard a certain of them. The ways they go about it is, first of all, they do a customer audit, right? So they audit their existing customers with certain risk ratings and sort of delineate the customers that will be MiCA approved and those that will not. They set up communication support structures, and choosing which customers they offboard to go into MiCA, they sort of balance out the reputational risk that can or cannot be mitigated if they were to keep on those customers or not. So for them, that challenge is by far the highest. The reason why is because a certain amount of customers prior to MiCA provided a high amount of margin and profitability and may not be going forward, including also the additional operational cost with complying with MiCA. And so they have to sort of really balance that out. In the middle category, the existing financial institutions that were never VASP to begin with, but are adding crypto products, don't actually have to worry that much about offboarding. They just look at, rather than looking at clients that are ineligible for MiCA, they're just looking for clients that are eligible for MiCA. So this could be your individual end users, certain business categories, they just don't offer that option or expose products or services towards them, but they just identify which one of my customers could use my new crypto products that I'm adding, and then identify that way. So they don't actually have much offboarding. It's more about picking customers that they could expose new products to. A lot of the existing licensed companies, whether that's banks or EMIs or so on, have already a very good experience with compliance and regulation. They're able to sort of pick through which customers they want to expose these to. And sometimes they'll do this in a gradual way so as to maintain good relationships with the regulators rather than adding a high amount of concentration risk by exposing all their customers to crypto as well. Another thing they'll do is they'll probably amend some of the terms and conditions they have with the customers that they opt into their crypto products, because there's certain changes that'll happen with regards to funds availability and processing times and so on and so forth. And from time to time, if it does happen, they might migrate a few, because certain actions of the customers that they've opted in might immediately violate some of their policies, and so they'll migrate immediately. Offboard immediately. But other than that, it's not as pressurized as the existing VASPs that were pre-MiCA and going into MiCA. Time to market. So we work with them. So we ask them and get sort of indication as to how long it takes them to get to market. If it's a brand new CASP, all the way from licensing to build can take really 9 months to a year, probably sometimes more, depending on how terrible the people you hired to help you with this. The better people you hire, the faster it'll be. The more experienced people hire, the faster it'll be. If you're an existing VASP, you might not have the best AML program that will be approved by MiCA, but you've got something existing, so it's just amendments over the time, added tooling. You might come see us. But those kind of things are sort of low friction, so the time to market is generally lower. Again, all depending on the expertise that you have. And if you are a non-VASP that's adding crypto products and has to get like a license, your time to market is significantly faster, because you already have a pre-existing prudential supervised status, which allows you to operate with a lot more flexibility, with a lot more impact. And so regulators generally are faster to provide that to you. So these are sort of the difference of the time to market for the different VASPs. Pros of each VASP type. Now, you can't choose to be one, of course, but if I were to say it, well, if you're a brand new CASP, you've got a clean sheet compliance design. You've got no previous skeletons in the closet to worry about. You get to write your own compliance program and just go from there. Let's jump forward to a non-VASP. There is a good pro there. You've got existing KYC channels. You just add a little bit more tooling. You already know the customers you want to broadcast to and so on. If you're an existing VASP, you have got a lot of skeletons that you want to bury now. You don't want them to show up. You've got a lot of retraining to do internally, because a lot of people have been sort of operating without a regulatory framework at all ends, from sales to developers to engineers to product. They've been operating in a pre-MiCA world, which is move as fast as you can. And then you might have to retrain and sort of retrain, not just procedurally, but also sort of mentally how to think about this in this post-MiCA world. And that can be a little bit challenging. But here's the cool news. You have existing customers already, which is so difficult in any space, whether you're in the banking, VASP, FX space. Customer acquisition is one of the most expensive things you'll ever have to do. But because you already have an existing customer, that cost is gone, which is amazing to look at. And some processes are already in place to begin with. There are certain cons if you're each of them. So for example, if you're a brand new CASP, basically all of your investor funds, that's if you are going on investor funds, and most all are, is going to be swallowed up in capital expenditures, almost all of it, with some amount remaining, hopefully, for customer acquisition. So that might actually be a problem for a MiCA applicant, because they'll look at your funding, they'll look at you want to grow, and they'll say, it's great you got 2 million in funding, but 1 million is probably going to be swallowed in policy, procedure, legal application, IT implementation, regulatory technology services, et cetera, hiring. Where do you have the funds to keep running once you're done? So it's super difficult for brand new CASPs in that space. If you're an existing VASP, that means you have an existing balance sheet. And if you have an existing balance sheet, there are a lot of previous products, processes, and so on that you'll have to just X. And that raises a high amount of technical debt. And those have to show up in your balance sheet somehow, which is not very good for you. And there's also a high amount of scrutiny, because regulators want to see, are those skeletons in your past still there, still here? So a lot of work needs to be done. And so that's one of those disadvantages. Non-VASPs that are adding crypto products that are also MiCA applicants have a difficulty, which is staff expertise, talent. All of the staff expertise, talent that I just talked about are working here or working here. And they generally don't want to come work here. So they have a hard time finding really good people to help them launch crypto products in their banking program or their EMI program, because that person needs to also know the products and the banking products and the FX products as well, in addition to being good at this and good at this. So for them, that's one of their biggest difficulties, is get the people, expertise, and so on needed. Also, parentheses, these people pay more to their compliance, crypto people than these do. So anyways, it's very hard for them to find staffing. Although the jobs here are much more long-term, more reliable. These depend on, investor funding and how long that lasts. But anyways, so that's sort of the difficulties and cons you see across these three different MiCA applicants. In our experience, because we work with them, we are very inquisitive, we ask a lot of questions, and we find this key nuances and differences across these three players. That's really the showcase I wanted to mention about these three type of applicants, and I'll just stop right here. While I was talking, the Zoom sort of notification bubble just kept going nuts, which means that there's a ton of questions here. So maybe we should just get to that right away.
All right. Thank you, Chris and Faisal, for your presentations. And now we can move forward to maybe I've seen, Faisal, you've chosen some questions to address. Maybe you could start with some.
Okay, let me just check to make sure I didn't misclick. No, I'm kidding. I did pick. It's just that there's so many. I'm not sure which one I did click. Oh, here we go. So the question was, in the case of an ART, which is asset reference token, backed by gold, does the MiCA regulation allow the possibility of exchanging such a virtual asset for the physical asset, in this case, physical gold? You should ask a lawyer this. However, I can give you an answer as a non-lawyer. The answer is yes. You absolutely can reference physical objects inside of your white paper, as long as it is inside of the white paper. And if it is referenced inside of the white paper, then you can allow for the redemption of it. However, and probably this is the question more why you asked, does the redemption have to be through funds or can it be through physical gold? If the prospectus, or excuse me, the white paper mentions that the redemption would be through physical gold, then the issuer has to absolutely provide you the redemption through physical gold. If it does not specify, then it has to redeem it through digital means. So it could be a funds transfer or whatnot. At the end of the day, the white paper is legally binding. So to answer your question, yes, as long as it's referenced in the white paper itself. I hope that answered your question.
The question of Sam was, how does the European Union plan to ensure consistent implementation of MiCA across member states, especially as new types of crypto assets and services emerge? First of all, just to address how it functions, MiCA has direct application, so which means it applies directly and uniformly without the need of the national laws being transmitted and adjusted. And also regarding the instruments that European Banking Authority and European Securities and Markets Authorities will be using are, of course, the workshops, open workshops with the stakeholders to receive feedback on the MiCA regulation and to, if applicable, improve it, adjust it, etc. And also MiCA have review clauses in the text, so it makes it more flexible to adjust for the authorities. And for example, the next review of the scope and effectiveness of MiCA is planned by the year 2027. And also the European Union can propose delegated acts to expand MiCA's scope whenever ESMA identifies any new crypto assets or services they might be added ad hoc to the MiCA scope. So this is how they are going to address the constant evolution of the crypto industry. All right, Sam, I hope I answered this question. Chris, I can give you the next question, please.
Okay, so yes, plenty of questions. So I'm just gonna go with the ones which you can perhaps not find as easily by searching in the internet. One of them is why Bitpanda has decided to go for 3 MiCA licenses as opposed to 1 or 2, especially with the passporting rights that now come along with it. Of course, purely my perspective, I am neither a founder nor C-level, but of course, first and foremost, one has to be aware that at the time of applying, we did not have the benefit of foresight. So when I joined Bitpanda now around 2 years ago, we did not have knowledge in terms of how different regulators would be approaching application procedures. So that was one of the reasons why we decided to apply for a license in more than one jurisdiction. To speak for Malta, Malta is one of, as I mentioned, one of the international financial centers within the EU that has managed to attract quite a significant amount of crypto service operators, some big names as well. So being in Malta also presents the opportunity for our organization to be a part of that ecosystem. So aside from as well other risk mitigating measures, such as having different entities offering different services or tapping into different countries, the idea is to allow for the segregation of activities to also avoid cross-contamination when you're offering different type of activities. Hope that answers the question.
Add one thing on what Chris said. So, Chris, it's very brave that you answered that question as directed to Bitpanda. I mean, you didn't actually have to. It's your personal IP and so on, but you decided to do that. It's nice of you. I can tell you just as a general, Bitpanda is not the only company that has actually done sort of multiple licenses. It actually is the sign of a smart company, and I'll tell you why. You see, when MiCA applications were opened up in different countries, a lot of the applicants did not know which country would change their own national requirements for it, or where it would change, or if it would change, and what the scope would be. And they did not want to have a single point of failure. And as crypto folks, you should know that you should never have a single point of failure. So they decided to take the path of having multiple licenses, just in case one of these states changes something in their own country license that would immediately affect their ability to deliver service to the rest of Europe. And so in order to have redundancies, they wanted to apply to multiple states, and they're not the only ones that did so. And I think that was super, super smart to do.
No, of course. And as I mentioned, obviously I'm sharing my purely personal experience. And obviously there could be other motives which I'm not aware of, but as I mentioned, I think out of a lot of the EU member states, Malta, as you mentioned, was one of the member states which had a framework closest to MiCA. So one of the member states that you might have anticipated less change. In fact, in some areas, Malta had to even go back on some of the requirements. So, for example, one of the requirements in the previous framework was for each entity to have a proper systems audit, ISA 3000 standard, which under MiCA it is not envisaged. So, of course, there are various reasons which I think come into play in deciding whether to apply in this member state or the other or both. And ultimately, then, nobody knows what the future holds. And I believe one of the questions was also, are you going to apply in other countries? Again, I think we will have to wait and see. Of course, within the EU, I think we're pretty set at the moment. Outside of the EU, we continue to expand. Again, public knowledge, we're expanding in the UAE, in the UK. So stay tuned. I'm sure there will be more interesting developments coming from our end in that front.
Maybe I can continue with the next question. The huge compliance burdens. How do you think the compliance teams will be impacted in the European Union as more legislation is in action? Most of the firms will definitely need more resources. Yes, absolutely. The compliance teams will need more resources, but the more crucial thing here is not just the quantity of people performing tasks, but the constant training and updates. That's all right. As a training institution, we advocate for constant training, and especially cross-functional training. Not only train your compliance teams on the new updates, even with MiCA regulation or with other regulations we have in place, but cross-functional training of each department, not only on anti-money laundering issues, but on all the updates overall. So you have that institutional knowledge being developed. So it's very crucial aspect. All right, Chris.
In the future, we would expect more blockchain auditing firms, more requirements on audit, seeing as I touched with it. And the way I would answer this question is that I believe something which the previous Maltese framework had, which is missing under MiCA, is in fact technology orientated regulations, i.e., having specific rules surrounding how a particular IT infrastructure is run and how it is audited. So far, it seems that MiCA will not impose any such requirements, such as that is applicable, for example, for e-monies or e-money institutions, for example, where in some jurisdiction they are required to carry out annual IT audits. But of course, MiCA is the first wave, and we're going to expect a MiCA 2 soon. Probably then there will be a 3, and we'll follow a very similar pattern as was the case for AML. So I think In reality, this was the first step for the EU to try and harmonize. Now we will need to start seeing even how the industry responds and the type of standards being set, not only by the regulator, but also by different companies competing against each other. And hopefully, we will see a bit more of a technology-orientated regulation following suit. Obviously, there is DORA, which already mandates a lot of requirements on how to deal with technology service providers. But of course, I think it's not a matter of drawing a line and putting our hands in the sand and not realizing that ultimately there are risks which perhaps MiCA falls short of addressing.
All right. In that case, since I get the last pick, I'll answer two questions. All right, so that's all good. The first question I'll answer is the one that actually starts with for Faisal, so I can't ignore that one. It says, do you foresee a global standardization of travel rule protocols, or will fragmentation persist? How might differences... Oh, wait a minute. You cheated here. You put three questions in one sentence. All right, here we go. Let's start again. Do you foresee a global standardization of travel rule protocols, or will fragmentation persist? How might differences in jurisdictional approaches, local laws, and regulatory enforcement impact VASPs, cross-border transactions, and the broader crypto ecosystem? Okay. So to answer the first part of that first question, if I see a global standardization of travel rule protocols, or will fragmentation persist? In the short to medium term, fragmentation will absolutely persist. Why? Because each of the service providers that offer travel rule compliance are making so much money for free that they have no incentive to be able to give up all that margin, right? So I'm not going to name drop each of the travel rule providers. You all know who they are, all the different ones and the different little cartels that they operate. But each one of them is making so much money independently that there is no incentive or disincentive to stop that practice. So, and they also know that all of you have to abide by it. So why would they ever stop doing something that makes a ton of money? And there is no one telling them they can't do that. So in the short to medium term, that's not going to change. You're still going to have multiple different travel rule flavors, okay? Implementation. That's the short and bad news. What could change this? Well, what could change is two things. One, if FATF in some way or end, FATF is the regulatory, for those of you that are not a compliance specialist, FATF is the regulatory guideline body, not a regulatory body, but guideline body. If it changes its viewpoint or says something that it's best to have a standardized approach, then maybe the countries would require that, in which case it would change the market providers for such. However, FATF, and I think that was recommendation 16, when it added the first time travel rule for crypto, said there needs to be travel rule. It didn't actually say about a standardized thing. It just said it needs to be travel rule. And it just basically said, figure it out. I'm paraphrasing. So all different consortiums and figure out that's easy money grab. Let's just build our own little cabal and cartel and just sell travel rule solutions. And so far, no one is telling them not to. This is going to have two options, two huge consequences in the medium term. Small companies that don't have a lot of funds and financing will not be able to compete because it's super expensive to integrate a ton of different travel rules as well and manage them. And it'll also inhibit a lot of companies from entering the space. At some point in time down the line, when people sort of outrage about the unfairness of new entrants, then maybe there'll be some converged, merged, single travel rule standard that it doesn't matter who it is. And so it'll happen down in the future, but not in the short term, definitely not in the midterm. I'm thinking at least, 7-8 years after, at best. So that's my question. That's my answer on the travel rule singularity. All right, and then there was a question here. And last question. If you could advise whether CASPs have an obligation to monitor fiat transactions, not just crypto transactions, and the simple answer is absolutely. You have to monitor your fiat transactions probably more than you need to monitor your crypto transactions for two reasons. One, MiCA tells you to, but two, you're probably working with a banking partner, a settlement partner, a treasury partner, some type of partner that's giving you access to fiat cash, whether that's through an integration or as their agent or whatnot, and they will 100% require you to monitor your fiat transactions. That is if you provide the service of exchange. Obviously, if you provide only crypto to crypto, there's no need to monitor your fiat transactions. But if you do, 100%, you absolutely have to monitor your fiat transactions. There's no two ways about it. And that's, I think, it.
Thank you, everyone, for joining. Thank you, Faisal and Chris.